Dean, I'm in Florida, South Florida. North Florida and the Panhandle had Hurricane Helene unfortunately go through and create massive devastation. From the oil market impact, will there be any impact on the oil market since it did shift to the east and not to the west towards Galveston and Houston?
First, having grown up in Florida, having a lot of roots in Florida, and having gone to the University of Florida, you have my empathy and sympathy. I really understand from your standpoint exactly what you've just experienced. And I don't mean to minimize it from an overall broad oil and gas market perspective. The hurricane hasn't been overly substantial. And the issue is if it goes further west in the Gulf of Mexico, it obviously shuts in oil and gas operations. Operators for safety, have to make sure they take all precautions necessary to make sure that the workforce is safe, the environment's safe, and that things don't break. We go through all the normal industry preparations for emergency through the fuel value chain to make sure that gasoline and diesel fuel are where they need to be. We coordinate with state and local agencies. We get waivers as necessary, but we do everything from a pretty mechanized standpoint of connecting all the dots to make sure these things safely get where they need to go and that people can evacuate seamlessly if needed. So that's the operation. That's where the oil and gas industry has really been part of Hurricane Helene and its preparations.
How is the oil and natural gas industry preparing as there is a pattern, NOAA data, National Oceanic Weather, where there's a large shift over the last 5 years towards hurricanes into the Gulf? Various different landing points, but there's a large shift towards the Gulf. Has that changed the industry's preparations or how they're looking at potential hurricanes in the future?
Well, there are definitely lessons learned from past hurricanes. And we can go all the way back to Hurricane Katrina, 2005, and think about the various steps and what's gone wrong and what hasn't, and where things need to be improved in terms of communication points, and especially making sure that the logistics work during a time of emergency. It's quite a machine, right? So the industry watches NOAA data and all the reports as they come out. There'll be situation reports that come out with the Department of Energy being central to it. You will see from a Washington, D.C. standpoint, from a state agency standpoint, people coordinating necessary fuel waivers to make sure that they can get fuel where it needs to be, when it needs to be. So all of that works pretty seamlessly, and that's a pretty well-oiled process, no pun intended, that's continued to work well. We've seen it in recent years, and we've seen it now.
It's working, and global oil demand is continuing to grow. In Q3, global oil demand achieved a record. This is pretty impressive. 103.4 million barrels per day. Dean, what's driving that growth?
You wouldn't know it based on the prices, right? But we have relatively tight market fundamentals. Record high demand projected to grow with consecutive records each of the next 5 quarters if you take the forecasts from the Energy Information Administration and other external sources. And the inventories are at historic lows at the same time. So we're sitting at the bottom of the 5-year range in terms of domestic inventories. The latest weekly data came out yesterday, showed a 4.5 million barrel drawdown in the United States. This is important. So we've got some things going on that are maybe a dichotomy between the current situation and what expectations are for the future in the market here.
For inventories being low, is that the Strategic Petroleum Reserve and also the industry reserves? How are you looking at that?
So there are 2 components. You're right. There is a Strategic Petroleum Reserve that's not what I just mentioned, and that is also close to 40-year lows. It's been increased by about 5 to 6% so far this year. So coming into this year, the administration thought it would be a good time to start to replenish the SPR. They've only bought for the SPR, procured a small amount of barrels so far this year. It's the industry-held inventories that when we were in the second quarter of the year, in the spring, it was right in the middle of the 5-year range and it was looking ample. But as we got through the summer, despite the fact that we had production rising, crude oil production rising to a record in the U.S. of as high as 13.4 million barrels per day, and we're sitting to the week here at 13.2 million barrels per day. So we're sustaining above 13 million barrels per day. We're sustaining around 6 million barrels per day of natural gas liquids on top of this. So this is historically, again, record high production. We're exporting a fair amount as well, but net, this is, we're drawing down these inventories. And the biggest change in EIA, the Energy Information Administration's outlook this last month, by the way, was they were projecting global stock withdrawals in the oil market for this quarter or excuse me, the fourth quarter of this year of around 900,000 barrels per day. And they've upped that to 1.3 million barrels per day. Plus, going into the first quarter next year, they've also increased the amount of net stock withdrawals on a global basis to 1 million barrels per day. So this says the world is short of oil, that consumption is outstripping the amount of supply in the market. And that's why when we get to news this last week that Saudi Arabia wants to put a little bit more on the market starting in December, well, there's probably headroom to take it given where demand is and the fact that by all indications, global stock withdrawals have occurred and are drawing down the amount of inventory to, at least for the U.S., the lowest in 5 years.
You're correct about Saudi. It's also they want to gain market share. Currently, Saudi Arabia is pumping 8.9 million barrels per day, the lowest level since 2011. By December 25, they want to get additional 1 million barrels per day online to 9.9 million barrels. What impact will that have on the market? Will there be enough oil if Saudi Arabia goes to 9.9 million barrels per day to meet the global oil demand?
Well, it's interesting because it suggests that if everything other than Saudi is producing as much as they can, and you've got demand at record levels and projected to grow, that then puts a fair amount of market influence into OPEC Plus's hands of, if they didn't increase output, you would expect some sort of price response. And as a trade association, we're not going to forecast the price precisely here, but we can talk about the fundamentals, and directionally, that's the pressure that's put in play. I think the market is interesting, and the financial markets have been tied onto a theme of economic weakness in China, demand weakness for oil as a result of that. And you have historically large amounts of people shorting oil this month. John Kemp of Reuters has been highlighting this issue. Javier Blas of Bloomberg has been highlighting this issue. So this isn't news, right? Or rather, for inside baseball, people, analysts following the oil markets, it is something to watch, but it's not a brand new revelation. And this has been rolling forward, these short positions. And if you look at managed money and swap dealers, two kind of non-industry players, it's interesting in the latest Commodity Future Trading Commission data, they are short oil 8-1 right now. This is not like a balanced view with people on each side. So for the people that are on the financial side of this, it really is a heavy bet that prices will go down. So you have to ask, if market fundamentals are tight, why is that? Why can that go? And then you have Jeffrey Curry having written a piece this last month that's talked about, trying to explain this dichotomy between low prices and tight market fundamentals. And his premise is that there's a carry trade that's basically being funded off of oil. I'm not sure I buy that, in the sense that I think there is a role of speculation that's playing out in this. And ultimately, it's going to come down to market fundamentals, supply and demand, as it normally does. But in the short term, you can get some perturbations based on where these markets tend to move and how it tends to move. And we're seeing that now. I don't understand, based on the supply-demand fundamentals that I watch and the fact that the economy isn't bad. It's not great. It's justified in the Fed's view, this 0.5% rate cut last week. So we're seeing it stabilized. And as it is stabilized, despite some potholes along the way, you would expect that this is supportive of the record high demand and growing that EIA and others are projecting.
The yen carry trade famously blew up. We saw the impact and volatility that created the markets. Could this short oil carry trade have a similar impact on the global market?
Unlikely that the proverbial tail can wag the dog here. You need to see something. We can go back and say, well, if we're betting on a football game and its outcome, can the betting on the football game influence the outcome of that game? And at the end, the answer is no. It comes down to the fundamentals of how the plays get executed. And in terms of supply and demand and where they come together in terms of inventories, we can read the tea leaves on that pretty clear and see it a mile coming. And what Saudi probably sees in their supply decision, by the way, is that we've this year seen the fruition of a lot of long lead conventional projects in Guyana, Norway, Brazil, Canada, and that slows starting next year. So as you have demand growth, that opens up some headroom for others to come in. And as the supply-demand fundamentals, if demand is evidently on track, then any speculative momentum on the short side eventually has to pay. You have to cover those positions, right? So net, you don't get to roll that forward indefinitely. The question is, when does it unravel and how does it unravel? And the notion, and the reason, by the way, if you unpack it, that I don't completely buy that that's a viable carry trade. And the notion of this, so that the audience understands, is that when a carry trade is really, I raise funds, and then you mentioned the yen carry trade, I could borrow in yen, convert it to dollars, hedge my foreign exchange risk, and then invest in US Treasuries and make a positive real return, despite having to hedge that risk along the way. That carry trade with Japan is basically evaporating right now. That's one thing. So if oil is an alternative funding source for that, it's not a very smart one in the sense that you are exposed both on the oil price and the interest rate side of that trade. I mean, if you have projections that you believe for record demand and growing and low inventories, you could be really out of position with that kind of trade. So we need to see where that goes. It's one explanation as to why people have the positions that they have, but you can only carry that theme forward so far. The China issue, and I think what they look at is the broader commodity complex, whether it's copper, iron, steel, others having been beaten up recently. Some of this reflects the fundamentals in China. And as China supports with liquidity, its economy and its real estate markets in particular, and construction, that looks like it holds together. And without projecting prices on it, the soft landing scenario that the Fed has premised things on and that is continuing, and then a softening of interest rates in the US and other places, should be good news that's consistent with this broader economic outlook that we have from the International Monetary Fund, World Bank, and others.
The Fed did 50 basis points. There's a 25 basis points or a 50 basis point cut on the table. I don't know which way the Fed's going to go. Chairman Powell's not made any clear indications of which way the Fed's leaning. And then in China, you had a bazooka of stimulus coming, 284 billion US. And on the announcement of that, the China-backed ETF for real estate went up 15%. The CSI went up 4%. And we're selling global luxury stocks that are dependent on China went up 20% this week. So obviously there's a pretty big movement there. Are global oil markets very sensitive to global central banks and rate cuts and rate hikes?
Well, I think we're seeing with so much liquidity around the world and asset prices being supported, and then central banks looking at it as needing to support asset prices to help keep the economy on track, to keep consumer spending on track, to alleviate the potential potholes that could take it off track. And the stakes are high, by the way. I mean, post-pandemic, given the debt overhang that we have and the deficits that we have, you can't really afford to lose it, right? So it's been a long put essentially on risk assets here, and that's what is continuing to play out that we're seeing.
Will China's stimulus have any impact on the global demand for oil? Will it potentially lead to a slowdown because China's economy is clearly slowing?
It is clearly slowing, but it's a matter again of expectations. So let's take for a second the International Monetary Fund coming into this year. They started with a projection of China's growth of only like 4.1, 4.2%. And if you'll recall, our conversation in the first quarter is like, well, that looks like they sandbagged it. It's too low. And sure enough, by March, it was up to 4.6 in their view. As of July, it's up to 5% in their view. And it's really two things in that global macro forecast. One is that the US and China account for about 60% of global growth. So really two economies to focus on to understand the majority of what's happening in terms of growth this year. Number two is that for China particularly, 5% started to feel like without more stimulus that was a bit of a risk to the downside. Now that they're getting stimulus, maybe that's plausible. So I do think it has an impact. I think it does affect global growth, hence oil demand, hence commodity demand generically across the board. Now, can they magically turn the dial to the right and go back to what they were in recent years? No, I think demographically, in terms of productivity, there's some things that are structural that can't just be papered over through stimulus and rate cuts. But that being said, the world does fundamentally depend on China for a lot of consumer goods exports. And every time I keep hearing the debate about tariffs, we should put 100% tariff on Chinese imports in the U.S. The issue, if you've ever gone to an IKEA, I mean, whether it's IKEA, whether it's Wayfair, whatever you get, Harbor Freight, you start realizing, wow, there's a lot that cannot physically be made in the United States, and especially if you cut off immigration, you don't have the labor force to do it, and a lot of Americans aren't going to do those jobs anyway. So you have this symbiotic relationship that exists with many emerging markets, and especially China for manufactured goods. And keeping those things affordable is part of the nexus of keeping the economy on track that we've been talking about.
There's a lot of the goods from China. I did a whole thing on air freight last week, and I learned that the valuable goods go on air freight, and I didn't realize this. Anchorage, Alaska is a major hub for the air freight to go into small airplanes because of the runway and the strategic location. We have a potential port strike coming on October 1st. Does that have any impact since a lot of those goods do come on barges? I know majority of the goods from China do go to Western ports, and those Western ports in the United States will stay open and only affect the Eastern ports, but will there be any impact, perhaps some of the Vietnam imports or anything that you're seeing?
So this International Longshoremen's Association potential strike could affect Gulf Coast and East Coast ports. And the first impact would be on container ships and goods, as we've just discussed. For oil and gas markets, LNG is transported, exported in a fundamentally different way. It's not going to rely as much on longshoremen for its loading, unloading, and all of that. It's if ancillary services in the event of a strike end up getting pulled in. So if you're looking at tugboats and people that operate the ports where there's just congestion in general that impedes the normal functioning and operations of the port, whether it's Port of Houston, Port of Corpus Christi, those are potential issues. And keep in mind that a lot of the crude oil and the refined products that we talk about in advance of winter here, where you've got heating oil and diesel fuel that gets moved to markets in Europe, to the Northeast, out of these ports this time of year. So it is an important time. It has a potential risk. And I'm aware that there are associations that are appealing to the administration as we speak. There's a House committee that wrote a letter to President Biden just in recent days, pleading with them to basically use all authorities to make sure that a strike is prevented. And there's a precedent for that. In 2022, there was a rail strike, and the administration intervened and basically made the parties arbitrate and go back and figure out how to reach an amicable agreement. It would be somewhat opportunistic to have a strike in advance of the election. It does have economic import. I think consumers would lose if this ends up happening. We need to figure out a way to have constructive negotiations and move that forward. And I have confidence that somehow it will. I think the parties will have to come together. It puts this administration in an awkward situation, though, because they really don't want to put their thumb on unions right in advance of an election. But at the same time, it is maybe an opportunity to show leadership. So they're going to have to figure out the net of that.
The Biden administration is between a rock and a hard place. There is an election coming up. The vice president is running. They've been very pro-Teamster, very pro-labor. And then if you look at then you have the economic issue, because I believe this, that it could increase inflation and perhaps the Fed will have to act. And then on the economic standpoint, you look at Europe, all the natural gas that we export to Europe, if they have a cold winter, and then hypothetically, if this strike goes on more than 30 days, you're in November, it's getting cold up north. There's a lot of economic issues. From a planning perspective, does Europe have to be potentially prepared for this because they might not get the amount of natural gas that they would normally get if operations were 100%?
Well, I do think natural gas is the least impact of the commodities we just talked about, and that continuing to go to Europe. Europe's natural gas storage for this time of year is nearly full, so they're in pretty good stead in advance of the winter. If they get a third consecutive warm winter, they'll muddle through and they'll be fine. If you get any semblance of a return to normal seasonality, the important thing that the market doesn't really factor in terms of these historically low natural gas prices, and keep in mind from July, August, and now September, when we adjust for price inflation, U.S. natural gas prices at Henry Hub are the single lowest on record. I mean, these are record low prices, and the growth has been of the supply is almost entirely associated gas coming from the Permian Basin. That's helped keep these prices low. That's both fascinating, but it means that U.S. natural gas storage serves a global backstopping role, especially for Europe, more than it ever has. And we can say, well, okay, I can only export so much because there's only so much capacity. But you would get a turn to the dial of the right where Mexico, instead of taking 3.7, 3.8 billion cubic feet per day as it has in recent months, that goes up to 6. That's the capacity there. Europe, instead of taking 8 billion cubic feet per day like they did in July, that goes up to, that's not just Europe, that's total LNG exports off the Gulf Coast and the Texas per the U.S. International Trade Commission data. But at 8, and then it's been 3 to 4, both to Europe and Asia each, and then a little bit going everywhere else. That 8 billion cubic feet per day of LNG can ramp up to 11 and 12. So that's where we are in terms of total capacity at exports. And if you pull another, add that up, an incremental 3 to 4 on an LNG, an incremental 3 on pipeline, another 6 to 7 total billion cubic feet per day of exports of natural gas, you're drawing down your inventories faster than you normally do. and the price response that comes with that. And then the beauty of shale is we can respond relatively quickly in terms of drilling activity and production as well. But we do have to have transparency about it. I don't know that the market, because the last couple of winters have been warm, really factors in the interdependence that we've got right now.
Historically, have lower interest rates led to more drilling, or is it all driven by market prices and market demand?
It's market prices and market demand, but it's also financial conditions. So the relatively high interest rates have affected the cost of capital for small and independent producers. And that has quelled a lot of the drilling activity. And then you get to this time of the year in the fourth quarter, and you have a budget cycle on top of it. So you might have a producer in the Eagle Ford, for example, where they've got commitments internationally, but they have the only flexibility they've got in terms of their budget at the end of the cycle is to maybe not complete wells. That's the sort of thing where we're seeing in some regions where the drilled but uncompleted well inventory has continued to increase by EIA estimates. We're seeing that means that the ability to bring more production in short order with completing those wells and bringing the product to market can go faster, as opposed to going through the full cycle of well development. Even as that's happening, where some of the DUCs are building up, the drilled but uncompleted wells in some regions, the productivity has been absolutely amazing. So this isn't just the Permian Basin. In the Eagle Ford, in the Anadarko Basin in Texas, even in the Haynesville area, Haynesville's a little bit weaker in terms of productivity gains, but as the weakest, if you go by EIA estimates of how much oil and gas you get as of this month compared with a year ago, running a rig for a month, it's close to 14% more in the Eagle Ford. How much more? And that's mainly natural gas as a mix there. But if we go to the Permian Basin, where it's the majority oil, you're getting over 20% more oil and gas, 20% productivity gains. This is not just longer laterals. This is fundamental learning and process improvements, the technology of data analytics, real-time targeting, being able to advance the recovery factors. In the past, it was always about getting the biggest initial production out of a well. And the industry was really focused on, how big can my well be? And wasn't necessarily focused on the expected ultimate recovery of resources out of that well. And you've seen much more thoughtful improvements in technology that are improving the recovery factors. And there's another phase beyond this that we haven't hit on. We don't have recompletions of wells, of going back to the mature wells and investing. For example, it can be $4 million that you spend to recomplete a well in its entirety. You can spend half that and do what's called a bullhead frac and basically do a less expensive partial recompletion of it. But a lot of the well designs that are 10 years old or more, they were spaced out in a certain way. There's a lot of resource yet to be recovered out of those wells. And if for $4 million, you can go back in, recomplete it, and have effectively another life to this well on top of that, it sort of blows out of the water this notion that the shale revolution has only a handful of sweet spots and it's going to necessarily plateau in the next couple of years. This says, and this is part of why EIA and others are projecting the U.S. to continue to be the largest single source of supply growth, not just this year, but in coming years. You are truly, when we're talking about 20% productivity gains year on year, one, it's showing that there's another potential leg to the shale revolution without having even hit upon well recompletions. And two, that has to be something that OPEC Plus really takes into its calculus in terms of market share, for your earlier question of how do they make sure that they're guarding their place in the market at the same time as the U.S. really looks like it's getting a second breath here.
How much of their productivity gains are being unlocked through automation and autonomy?
Well, it's not pure autonomy, but I think the best example I can give you, having talked with some producers recently, is that in the past, maybe you had institutional knowledge and experience coming in and making production decisions, and then the data being used to justify those decisions or corroborate it. But now, because of data analytics, the visualization of those, the steps have been taken forward, you're seeing people fundamentally use the data to speak and inform what those decisions ought to be. And the actual recoveries, the precision with which they can target drilling, the ways in which they can target the resource itself and improve the recoveries, it's been a fundamental improvement. Again, 20% over, and it's even more than that in the Eagle Ford. The Anadarko is also above 20%. Each of these are the sources of growth right now for Texas. And Texas, as of July, produced over 5.7 million barrels per day of crude oil. plus another 3.85 million barrels per day of natural gas liquids, plus another 32 to 33 billion cubic feet per day of natural gas. All three of those are records. So the idea that we're seeing strong productivity gains, record amounts of production out of the state that's producing the most growth here, it's a pretty good sign for the industry.
It's a good economic sign. Another trend that I'm starting to see in computer vision world is Houston's emerging as an AI hub. A lot of talent is moving to Houston to develop, coming in for NASA, developing for the oil and gas. It'll be very interesting to see once that AI talent is established, the hub's established, the large language models, the neural nets are all built, that it starts to work its way into the field. Do you have any outlook on that when those new AI models will eventually work their way into the rigs and into the fields?
There are two aspects to this. One is the development of the algorithms themselves, and then the companies that are using it basically as a technology hub, because both the technical expertise and then the application to the energy industry exists in the Houston area. But then there's the power, electric power aspect of it, and economic development aspects regionally across Texas that are looking at how much of generative AI data centers and such can we attract to the state. Virginia, to be clear, is still attracting about 3 times the investment, the construction backlog in terms of data centers. Ohio is actually more than what Texas is right now. The interest, especially in growing this in West Texas, is quite high as a source of natural gas for power. It's obviously ample, and there's excess natural gas that can be used. The challenge is generation and transmission and being able to build it out fast enough. I'm of the view, and I'm actually speaking on Monday at a conference here locally talking about the build out of the Permian Basin and the electricity load that goes with that. And it's interesting that oil and gas production in recent years has moved off grid from ERCOT. There's been a lot of self-provision of electricity because they can't go fast enough to keep up with the production. And that's the trend that has been okay for oil and gas. It would be more efficient and better, and the opportunity is large for the electricity sector to expand in serving that load. But to attract data centers, the investment, power is one consideration. Connectivity to the internet, fiber, everything you need for networking is another. You need a qualified workforce, both, and some of this will be automated, but not all of it. And you need people with advanced degrees in this area to make that go. So there's a workforce training issue that goes with it. And frankly, there are just land and water and other issues that go with trying to have power. So we're going to need cross-industry solutions that really work together between the tech sector, the oil and gas sector, the generators, trying to make sure that all comes together and can really have an integrated solution that makes it attractive for them to come to this state instead of Pennsylvania, Ohio, Virginia, or other places.
Let's not forget one of the most important things, and I'll just say it. You have a really great, stable regulatory environment. And you have a governor that's pro-innovation, and that makes a very big difference.
Absolutely.
The oil and natural gas industry plays a large role in Texas' economy. What impact has it had on Texas' economy this year?
Well, at the end of this year, we'll size up the direct contributions, but in the last fiscal year for 2023, the industry paid $26.3 billion of state and local royalties in Texas. $26.3 billion from one industry in Texas. That exceeds the entire state revenues of 36 states. All tax receipts for 36 states, but paid by one industry in one state. We are really critically important in terms of what we're contributing to schools, roads, communities, and the state's economic activity. And keep in mind that a lot of the activity through the value chain, the advantaged feedstocks that come from oil and gas, it's what helps keep electricity prices in check at the end of the day. It keeps manufacturing going. It keeps exports going. Through the first half of this year, Texas has exported $115 billion worth of energy products. It's a big deal.
Hold on. I gotta highlight this. Texas exported $115 billion in energy exports?
Just in the first half of this year. That's just through June.
So let's just do simple math. You can't comment on this because the data's not there, but hypothetically, you could double that to $230 billion.
For sure, and if the price environment, plus or minus, based on where that goes. But clearly, the volume is there, and that's where the international pull for all of this, as it continues to grow, LNG exports continue to grow, and capacity expands. This has been a resounding source of economic growth, and it's really helped consumers both in the state as the production and productivity has continued to help keep things abundant and prices with downward pressure here in the state, but we're also serving global consumers. And things are, imagine Europe without the supply today.
Europe would be in trouble. I'm just running numbers in my head here because I'm flabbergasted in a very good way. So you have $230 billion potentially in energy exports. Then you factor in a very growing tech scene from Austin, Dallas, Houston. You could be exporting 500 plus billion dollars in no time of various different exports with energy and technology. You become the most important state in the United States. Sorry, California, but truly, if this is where Texas is going, you become the most economically important state. Is Texas prepared for that, to hold that mantle?
Well, you pointed toward the business climate here and the strength of the governor and the administration in being aligned, of understanding the importance of business and its compatibility with the state as a whole and the population doing better over time. I think it's been a resounding success, but we can't be complacent. We need to make sure that our energy costs remain low, that the things that have made us successful, which starts with that culture, it starts with the access to the resources, it starts with the ability to be able to expand infrastructure quickly, that responsiveness. And it's not just pipelines and processing, it's through the exportation of all of this through the value chain. Texas has been able to move at a speed of business that's been compatible with this kind of growth. I think it's foreseen the opportunity and been well positioned to take advantage of it. And then I think we talked about this last time, but then you have the Chevrons and the Teslas and others locating their headquarters in Texas and doubling down on the strong workforce and the strong value chain here.
X is coming. Elon's publicly stated that. There's an article in the Austin Statesman that's going to go about 30 miles outside of Austin. So that's another job creation. You have Oracle there outside of their healthcare, which is in Nashville. There's a lot of businesses going there. And then you have Dell. You have to give Mr. Michael Dell in Austin a lot of credit. Dell recently joined the S&P 500 last week. So congratulations to Mr. Dell on that. It's been one heck of a comeback story. When I look at Texas, and you publish these fascinating quarterly reports, and we'll link to it. And if you're interested in economic data on oil markets and all things economics, highly recommend you read Dean's Quarterly Outlook. In your Quarterly Outlook this year, you highlighted a trend that I found a little bit disturbing around household debt and delinquencies are growing in Texas. What's causing that? What's behind the data there?
Well, it's Texas, Florida, New York, California. They've all had adverse trends, and this isn't new. And the $17.8 trillion worth of consumer debt that the New York Federal Reserve Bank in its credit monitoring has highlighted, and that's as of the second quarter of this year. It's a record high. It's continuing to grow. It's been, as household savings from the pandemic have worn off, it's been a need to make ends meet, and depending upon the employment situation, taking on some debt to kind of continue to have things go as usual without making some hard trade-offs. When we look at delinquencies of different kinds of debt, credit cards, auto loans, and mortgages, and there are different flavors of delinquency, but those that are 90 days or more are, in their parlance, considered serious delinquencies that are harder to come back from. For autos, those are getting really high. Credit cards, they're up. Mortgages, not at recessionary levels. It is notable that auto repossessions and home foreclosures are not nearly up as much. So it says that people are stressed, but they're prioritizing what they need to spend their money on, and they're making sure they have transportation and homes. But that does suggest that you would see other consumer spending come under pressure. Now, we've had mixed reviews of consumer sentiment. Polls, whether it's the Conference Board or the University of Michigan survey, that talk about how people feel about the current state of the economy and their economic prospects in the coming quarters here. If we look at the Michigan survey, which in my experience correlates really strongly with the growth in consumer spending, keep in mind that on an expenditure basis, consumer spending is 70% of the U.S. economy. The growth in it really matters. And this says that based on that survey, even though there's been, it was higher, it's come down. It goes a lot with the stock market, actually. As financial assets are held up, people feel better about the value of their home, the value of their equities. They feel more secure toward retirement, all of that. So the unemployment rate, the employment situation was concerning enough that maybe the Fed was concerned that it's actually worse than the data appear. But the data were basically showing a kind of subpar form of non-payroll additions or growth, a 4.2% unemployment rate when their target's 4.4. They probably anticipate that that's drifting up toward target with some economic slowing, and that the stimulus was maybe justified on that basis. I've noticed over the last couple of months, though, that the market kind of throws a fit. It wants more rate cuts sooner. and it's now discounting in another 80 basis points or so of cuts coming in. And we'll see if the justification in the data is actually there for that. They got a big move. I think there was an argument that the Fed could have moved in July and didn't. So, net, they move ahead, and here we are with the half percent cut this month. We'll see where they go. I don't think it's a slam dunk that you necessarily have a commitment to a path of continuing to do this each month or each quarter. I think it's going to be very data dependent. It's going to be wait and see. And if you're seeing asset prices, S&P 500 and other indexes continue to rally off of this, there's a point at which you look at that and say, well, is it really justified based on the projection by S&P Global? If you look at index earnings on the S&P 500 website, you can pull up the operating earnings per share projections for the different sectors of the S&P 500, and they're not bad, but they are slowing through the next year. The next 4 quarters of expectations are slowing. So what is it against that environment that justifies an all-in multiple for the S&P 500 of 21, 22, 23? It's creeping up. Even if you take out the high-flying tech stocks, it's still close to 20. So these are historically pretty rich valuations. There's no other place to put your money and do better right now. So again, the long put kind of thing that we talked about. But you do have to ask, and you have to say, okay, how fundamentally justified is this if you have this undercurrent of slowing earnings in the next year?
Earnings are slowing globally. Look at Europe. Europe is starting to slow down pretty tremendously. At the same time, the euro strengthens, the dollar weakens. Are you watching that at all from an impact on the oil markets of a weakening dollar and a strengthening euro?
That is less of a primary factor for oil than looking at the things that we've talked about global demand growth. The broad strength of the dollar does have a very strong inverse correlation. And with these rate cuts, historically, you would expect that if the dollar broadly weakens, that should be upward pressure on prices, other things being equal. For Europe specifically, they've had a couple of years of rough patches, and maybe it's eternal optimism, but in the International Monetary Fund's latest upgraded outlook that we talked about as of July, they've got Europe up to 1.3%, 1.4% growth on a market exchange rate basis the next couple of years, up from less than 1% this year. So they actually see, and again, it could just be misplaced optimism, but they see some improvement over the next 2 years in the European outlook, consistent with a global outlook that grows. Again, I adjust to a market exchange rate basis instead of a purchasing power basis, but 2.8% per year over the next couple of years in their view, looking across 200 countries individually. Well, 2.8% is above average. So you have to ask yourself, does this feel like an above average outlook? And for the questions that we just talked about on the consumer side, it's one of dichotomy. It's one of winners and losers in an environment where interest rates are still relatively high relative to recent history, where some industries are doing well. We're seeing in equity markets a rotation toward now interest rate sensitive sectors are potentially benefited by the fact that we're beginning to cut rates. But we need to see if the macro data actually justify continuing to cut rates as much as the market seems to be factoring in.
If global growth holds, does the demand for oil continue into mid to late 2025?
Almost assuredly, yes. And the one thing that we've learned since the pandemic was just how in lockstep economic growth at the global level and oil demand have continued to be. When we shut down sectors of the economy, it went down in 2020. When we look at the actual recovery and back to trend, we are at these record levels for a good reason. And it's because despite all of the messaging and everything that's gone on with energy transition, it truly is an energy expansion where we're seeing emerging markets lead this growth. China continues to need more energy, not less, even if its growth is slowing. And that is the message, is that let's say that we got some downside economic surprise and growth globally only came in at 2% instead of the expected 2.8. Based on that relationship, the world would still need about 1 million barrels per day more oil next year than it does this year. Big business implications off of that. Again, talking the supply dynamics where, we discussed Saudi Arabia's decision to open up a little bit in December. Things move around, but it's still a growing market. And if you add 1 million barrels per day to where we're standing today, it's still a record level again next year.
When do the markets begin, and the oil market specifically, begin to feel the rise of India?
So, India has historically been an interesting case because it's a more service-oriented economy. Their economic growth is not as oil intensive, as energy intensive broadly as China's, for example, but they still need more energy. And it is, and you're seeing a lot of ties, for example, out of the Middle East trying to tie up long-term customer relationships with both China and India for that reason. So supplying crude, having refineries in country, having the value chain. Hypothetically, let's say that you expect demand to plateau in coming decades. The one that has the customer relationship at the end of the day is the one that wins, right? So having that value chain in place, having the assurity of it, there's a reason for that competition. I think people have anticipated India's growth continuing to be strong, the demographic growth underlying it continuing to be strong. China has different demographic challenges fundamentally, and that becomes more of a headwind to China's prospective growth, whereas India has a tailwind for decades to come here.
India's, while I'm watching it, I'm studying the market closely. It's a rising market. It's a growing market. It'll be interesting to watch over the coming quarters and the coming years as India essentially comes online. They diversify their economy away from services. Perhaps they go more into industrial. We don't know. That feature is yet to be written. But we do know over the next quarter, we are going to continue to have robust oil markets. Dean, what should our listeners and viewers look for in the markets over the next quarter?
Again, data dependent. So that means now more than ever, really looking at the data as they come out and understand the implications of these indicators, whether it's the importance of the employment situation in the U.S., what's happening with the U.S. dollar, and how that interacts with the rate environment. All of these have a cascade effect through oil. And then we have this new overlay that we talked about of what's actually happening with speculation vis-a-vis the fiscal market. And that one, we're going to have to see how that next chapter gets written. But it's a really interesting issue. If people are interested, we have, in addition to the article summary and this quarterly presentation, our quarterly economic outlook, we have a weekly chart book that we put out on TXOGA's website. It's accessible at txoga.org. In the economics section of it, we have the weekly chart book. We also have a monthly energy economics review. And it's a little more inside baseball, but we fill in with production forecasts for oil, natural gas, and natural gas liquids, a lot of the data to the current month that, whether it's from EIA or the Texas Railroad Commission, aren't up to the current month, or usually a couple months in arrears at least. And we also have the entire value chain laid out, all the inventories and flows and transfers and trade for oil and for natural gas. So it's a little statistical in basis, but if you're interested in energy, it's really a treasure trove of data.
It's fascinating. I personally love reading it. I'll call myself your biggest cheerleader in autonomy because you publish really great, interesting data. We have you on every quarter because your data is flat out awesome. Dean, love having you on. Looking forward to having you on again next quarter. There's a lot to talk about. The future is bright. The future is autonomous. The future is a healthy and robust oil market. Dean, thank you so much for coming on the road to autonomy's Autonomy Economy.
Thanks, Grayson. I've really enjoyed it.